Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Europe is the place to invest so far in 2023. U.S. stocks are off to a good start. The S&P is up 7% so far, but Europe is far outperforming. What's going on? Let's talk with Matt Bartolini. He's the head of Spider America's research for State Street. That's part of the team that oversees one of the largest European ETFs, Spider Euro Stoxx 600. Vance Barst, the founder of your dedicated fiduciary, also joins us as well. Matt, all the major European ETFs are up 15 to 20% for the year, and we're at new highs last week, including your own Stoxx 50 ETF. That's up 20% this year. Give us the lowdown. Why is Europe doing so well this year?
Well, when we look at it from a few different factors, particularly quantitatively, we see that fundamental valuations are supportive. Relative valuations relative to the Euro Stoxx own history or towards the S&P 500 or equity are constructive. They're trading at a larger discount than normal. So those valuations were attractive for investors to step into as the year started. And those healthy valuations were also being met with actual earnings upgrades. So we've actually seen earnings for 2023 for European firms actually increase. And that's completely different than what we saw for U.S. firms. We've seen U.S. earnings be downgraded. So you have those two factors at play, valuation and sentiment. Those are both pointing up for European markets. And then throw in some strong price momentum. And those are three quantitative factors that are adding support to this rally and the interest we've seen from investors so far in the ETF market, where we've seen a significant amount of inflows into those European-focused ETFs.
And look at these returns here, and these are broad European ETFs, including your own, Matt, FEZ there, right at the top, up 20%. Now, a lot of people like to say that this is just luxury stocks, and it's true. LVMH, for example, and Rolls-Royce, and a lot of these luxury stocks have far outperformed. Some of them are up 20 to 40%. But when I look a little deeper, even the consumer stocks, everyday consumer stocks, Adidas is up 20% or more. Bear is up 20% or more. So here's some of your luxury names that are moving, but look at some of the other ones that are out there. Adidas, Bear, SAP, Stellantis, they're all having a good year as well. So I guess my point here, Matt, is it's true that luxury is doing well because they sell to China, which is reopening, but there's really a broader story going on. You can't just say it's just luxury.
That's right. And when I was discussing those metrics earlier, that's on a broad-based level. So the market itself was being attractively valued, and the market itself was seeing earnings revisions move to the upside. So from an investor's relative positioning perspective, you have attractive valuations and positive earnings sentiment overseas in a much more stronger fashion than you do relative to the U.S. And we've seen investors make that relative positioning perspective by going overweight European equities and using the capital from sales outside within the U.S. So basically, buy Europe and sell U.S. has been some of the trade that we have seen.
Vance, I want to bring you in here. We were discussing this 6 to 8 months ago, Matt and I and a bunch of other people, and the consensus at that time, late summer of last year, was the war in Ukraine was going to have a very negative effect on European earnings and valuations. But I don't want to downplay that horrible situation over there, but how has that perception changed? It seems to be very different now, 6, 8 months later.
100%. I think that the collective investor psyche has gotten used to the war in Ukraine being an ongoing item and nothing new. Now, at its outset, there was a very strong risk-off trade idiosyncratic to Europe because it was the first armed conflict that we have seen in Europe in decades. When we look at valuations, and to echo some of Matt's thoughts, historically, the euro trades at about a 15% discount to U.S. valuations. Now, they're currently about 30% at a discount relative to the U.S., so I think that there is some optimism that that spread could narrow as we see things like the ECB projected to cut rates starting in early 2024. Hopefully some peace and resolution comes to the war in Ukraine. And also, of course, China reopening, which bears no explanation given its role in global trade and distribution.
Yeah, I think, Vance, people need to understand how important what you just said was about the relative valuations, and particularly Europe trading as a value proposition. So traditionally, if Europe trades at 15 times forward earnings, and now it's at 14, well, there's a little bit of a discount. But the United States traditionally will trade, pick a number, 17, and it's close to 19 now. I mean, that's a big spread. 19 versus 14 is a huge spread. It's, as you mentioned, almost a 25, close to 30% difference. So that's very unusual, that spread, but also the fact that it's trading on a very relatively high value basis would make it attractive independently of whether there are other things going on. So you got to, I guess, Vance, emphasize the fundamentals here of what's going on, that there's a relative value proposition here.
Yeah, very much so. You know, Bob, when we look at U.S. growth, it has been slowing because of where the Federal Reserve is in the rate hike cycle. But we have not seen the same level of rate hikes over in the Eurozone as it relates to the ECB. So there's some fundamental factors at play here that can certainly help explain the year-to-date performance that we have seen of European markets, particularly in the luxury goods section. You know, one of the things that I was reviewing prior to the show is the decrease in the cost of nat gas. Naturally, with winter coming here in just a few short months, we anticipate that the cost would go up. But it's been a pretty significant sell-off this year in terms of the cost, which could arguably be a tailwind for the European consumer to help spend on those luxury goods.
You know, that's a good point that we had that was just made there. Matt, everyone was concerned about the price of natural gas and the price of heating, and it didn't happen. We had a relatively warm winter, not just in Europe, but in the United States, for whatever reason. Is that not a major factor as well here? We just had favorable climate situation.
Yeah, I mean, at the start of, or middle of last year, there was probably more of an overhang than anything else. That's some pretty negative sentiment about what the energy crisis could do for forward-looking growth expectations. And the fact that you did have a warmer winter, and perhaps there was some stockpiling built up in terms of the energy that could be consumed, those fears are obviously going to be lesser now. And so that overhang that was, weighing on some of the sentiment is obviously gone. And that has released some optimism into the European market. And we're starting to see investors come into that because there are more things pointing up than there are more things pointing down for the European markets.
Yeah, and I want to go back, Vance, to earlier points that we were making about why Europe is outperforming. We talked about the relative valuations, but another key point that Matt made earlier was earnings are rising. So in the United States, generally earnings estimates are going down. They've been going down for the first and second quarters, but earnings estimates are rising over in Europe. On top of that, we also have a weaker dollar. So there's several factors here besides relative valuation that are really becoming very important. Why are earnings rising overall?
A number of factors. The first of which is fundamentals. If you look at unemployment relative to where it was a few years ago, that has improved. The forward rate hike path for the ECB is projected, believe it or not, to see an actual cut in Q1 of next year. Obviously, anything can happen. The level of inflation, so year over year, if you will, is anticipated to drop from its current level down to 3.3%, again, year over year, in the fourth quarter of this year, and then hover in that high 2% range the first half of 2024. Naturally, that gets us closer to the ECB's 2% target. And we also have to consider the fact that there are currency plays afoot here. The euro is weaker than the dollar. So if we look at the disproportionate effect of profitability in manufacturing items in the euro, selling them in dollars, and then bringing those profits back in the euro, those things are all serving as tailwinds.
Yeah, and Matt, I want to go and emphasize the dollar here because this can be a very important, when you translate profits from one currency to another, you can get a big difference. Tell us why the dollar has been weaker recently. I mean, it seems to me the obvious answer is the Federal Reserve has been hiking rates much more aggressively than the European Central Bank. Is that correct? Is my assumption correct? And is there anything else going on here?
Well, at the end of last year, the dollar was trading in basically 20-year peaks, and that was, far too high. So we've seen the market recalibrate their expectations for what the dollar would be trading at, and the dollar has come off of those peaks. And part of that is that the Federal Reserve was massively aggressive in 2022, and they signaled to the market they would be less so aggressive this year, so that sort of interest rate parity type of valuation metric is no longer significantly increasing the dollar. So we've seen the dollar come off of its peaks, starting to decline. Meanwhile, the euro has strengthened as a result of that dollar's weakness. And I think in our currency team's view is that the dollar could materially weaken further as the Federal Reserve, again, really slows and potentially, starts cutting rates as well.
Yeah. So the important thing here, folks, is a strong dollar makes imports cheaper and exports more expensive, and vice versa. And it can dramatically affect earnings situation. In fact, big multinationals like Procter & Gamble routinely will have a paragraph in their earnings report about the influence of currency. So the point is, here, the weaker dollar is a headwind, excuse me, a tailwind for Europe and European companies. I want to just talk about relative outperformance, reversion to the mean. This is a statistical portion of the show. Europe, Vance has underperformed. I mean, dramatically underperformed for 10 years. I think we have some charts here. The S&P 500's up 260% in the last 10 years. The stock 600 is up a little more than half. There you go. Thank you. The Stocks Europe 600, which is sort of the S&P 500 of Europe, is up 158%. That's a lot, folks. So you're wondering, is that statistically significant? Yeah, that's a huge difference. So I guess, Matt, some mean reversion would be, there's your chart. There you can see it. The white is the S&P, and the orange is the Europe Stocks 50, which is similar but a little smaller than the 600. You get the idea here. I guess some mean reversion is appropriate at this point, independently of Ukraine and all of that. Some mean reversion is almost inevitable, right?
Yeah, that's correct. I mean, at the end of 2022, international developed ex-US stocks had underperformed the US or the S&P 500 for 55 consecutive rolling 12-month periods. That was almost a record. And then December 2022, non-US equities finally beat US equities. So there's a little, changing of the tides or turning of the tides here, where we're starting to see leadership emerge outside the U.S. I think part of it is just those valuations. After many years of underperforming, those valuations are attractive, and we have seen U.S. equities become, relatively priced for perfection, which obviously is quite different than the Europe, where there's some value to be extracted.
Yeah. Let me, Vance. Do you have any other observations on the rest of the world? We're focusing on Europe here because the European country stocks and a lot of European luxury stocks hit new highs last week. So we noticed that here at CNBC. But Vance, what about the rest of the world? Do you see anything interesting going on in Asia, in South America? We tend to be very U.S. focused here in the United States, and we have an opportunity to sort of talk about global movements. Anything outside of Europe that strikes you of interest?
Yeah, specifically, Bob, emerging markets have really caught our eyes simply because as we anticipate the dollar potentially weakening in the future, we believe that could be a tailwind to emerging market currencies and other currencies. And so we have ratcheted up a bit the allocation that we have to emerging markets, really is part of the overall increase that we have made to international markets. We are not solely married to international developed markets like Europe. We do like to differentiate the different parts of the globe, if you will, and also the sectors therein. So we have not only, in addition to increasing allocation to Europe, we have also looked at emerging markets, particularly as it relates to currency play. And we're seeing asset flows demonstrate that. Look at the year-to-date moves, not only in performance, but in asset flows across the globe. And you look at the outlook in the U.S. relative to the rest of the world, particularly in light of monetary policy. And clients are bringing this up day in and day out. Where's the opportunity? We want to be there.
Yeah. Matt, how about you? Vance, like emerging markets, any other parts of the world that are interesting to you?
Well, I mean, emerging markets is sort of the same idea from a valuation perspective. Sentiment isn't as strong in EM from an earnings perspective. So for that reason, it's still rather stay in non-developed ex-US equities. So you think EFA stocks, there's less geopolitical risk there than there is over in emerging markets. So for that reason, sort of staying in those developed areas, I think is something that we keep on having discussions with clients, just because there is constructive valuations, positive earnings sentiment, and to a degree, less macro risk than when viewing it versus emerging markets.
Yeah, I agree with that. I mean, the political risk gets very high these days, particularly with the conflict with China going on. All right, folks, we're going to have to leave it there. Very interesting discussion. Again, we don't focus that much on non-U.S. equities and ETFs. This was our show devoted to that. That does it for this week's ETF Edge. My thanks to Matt and Vance. We've asked Vance to stick around and chat a bit more about ETF trends for the ETF Edge podcast that's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.